Hi everybody, and welcome back to video number 4 in chapter 8. And we were going to look at determining ending inventory by applying the gross profit method. So here we will look at determining the cost of goods available for sale by adding beginning inventory to purchases. Pretty standard there. Then number 2, determine the cost of goods sold by subtracting the estimated gross profit from sales revenue. Pretty easy there. And number 3, determining ending inventory by subtracting the cost of goods sold from the cost of goods available for sales. Let's look at that. Here, the Lowry Stores has a beginning lumber inventory of $60,000 and purchases $200,000, both at cost. Sales at selling price amount to $280,000. The gross profit on the selling price is 30%. Lowry applies the gross margin as follows. Here's their beginning inventory. Here are purchases, cost of goods available for sale. And then if I shift over to the sales side, I have sales revenue of $280,000. Gross profit then at 30%, given in the problem, would mean that gross profit would be $84,000. So that gives you your estimated cost of goods sold, 70% of $280,000 here. Subtracted from the cost of goods available for sale of $260,000 leaves me with an estimated ending inventory at cost of $64,000. The current period's records contain all the information Lowry needs to compute inventory at cost, except for the gross profit percentage. Lowry determines the gross profit percentage by reviewing the company's policies or prior periods' records. In some cases, the companies must adjust this percentage if they consider prior periods unrepresentative of the current period. So 30% is an estimate. All right, so here in the previous illustration, gross profit was given, but how did Lowry derive that figure? To see how to compute gross profit percentage, let's assume that the article cost $15 and sells for $20, a gross profit of $5. So $5 as a percentage of $20 gives me the markup percentage of 25%. Now, in the case of markup, that's markup at retail, the markup at cost is going to be $5, the gross profit, divided by the cost of $15. That gives me 33 1/3% on cost, right? So 33% times $15 is the $5 gross profit. Okay, so those gross profit formulas you probably want to keep in your notes is the percentage markup on cost divided by 100% plus the percentage markup on cost. Now the percentage markup on cost here is going to be the gross profit on the selling price divided by 100% minus the gross profit on the selling price. That's what we just did in the prior slide. Okay, so you want to keep those formulas handy for the homework. All right, so let's look at tea time. Tea time has gross profit on selling price of 20%, and jasmine tea and 25% gross profit on selling price of its matcha tea latte, green tea latte. Tea time has a 25% markup on cost for its herbal tea and a 50% markup on cost of its chai tea. Okay, so based on that, we can now calculate these percentages on markup on cost by taking the given 20% and then taking 1 minus 20% and divide it into 20%. That will give us these three numbers. And the same thing for herbal tea and chai tea. Okay. So now once we know that, so the disadvantage of the gross profit method then, it's an estimated value. That's the big disadvantage. They must take a physical inventory once a year to verify the inventory. The gross profit test does not take into consideration the possibility that some goods have been damaged or stolen. Additionally, it relies on past percentages, and although the past can provide answers to the future, a current rate is more appropriate. Note that whenever significant fluctuations occur, companies should adjust the percentage as appropriate. And finally, the varying gross profits require caution because frequently a store or department handles merchandise with widely varying rates of gross profit. In these situations, the company may need to apply the gross profit method by subsections, lines of merchandise, or a similar basis that classifies merchandise according to their respective rates of gross profit. Okay, let's take a look at Marling Corporation. On April 30th, inventory is washed away by a hurricane storm surge. Not good. The beginning inventory was $300,000 on January 1, and purchases through April totaled $700,000. Sales revenue for that same period was $1,200,000. Marling's normal gross profit is 40% on sales. So using that gross profit method, estimate Marling's April 30th inventory that was lost in the storm surge. Okay, our beginning inventory, $300,000. We purchased another $700,000. That gave us a cost of goods available for sale of $1 million cost, right, so far. Then on the sales side, we have sales revenue of $1.2 million, and gross profit would be 40% of the $1.2 million, or $480,000. Subtracted from the $1,200,000, we get $720,000. And that's our estimated cost of goods sold. So our estimated ending inventory that was destroyed in the fire would be the $720,000 subtracted from the $1 million to get $280,000. Okay, now we can also determine ending inventory by applying the retail inventory method. So here we can use that sometimes for interim reports, a fairly quick and reliable measure of inventory. It's helpful to insurance adjusters who use that information to estimate losses from fire or flood or other casualty. It's a control device that forces the company to explain any deviations from a physical count at the end of the year. And then we can use it to expedite the physical count. It saves time and expense because the crew taking the physical inventory only needs to record the retail price of each item, not each item's invoice cost. That saves a lot of time and expense depending on the company. Okay, here's Kelvy Company. Beginning inventory cost $14,000. Retail price $20,000. The company also purchased inventory at a cost of $63,000, which has a retail price of $90,000. Acctg has sales revenue for the period of $85,000. Okay, so here is our costs, $14,000. We added purchases of $63,000, available for sale, $77,000. The retail price associated with those was $110,000. So our ending inventory at retail was $85,000. We got that by taking this $77,000 as a percentage of this $110,000, and that gave us 70%. 70% then times $25,000 is going to give us our estimated inventory at cost, or $17,500. Markup cancellations, markdowns, and markdown cancellations. Markup cancellations, markdowns, and markdown cancellations. Markup cancellations are decreases in prices of merchandise that the retailer had marked up above the original retail price. Markdowns are decreases in the original sales prices. Such cuts in sales prices may be necessary because of a decrease in the general level of prices, special sales, soiled or damaged goods, overstocking, and market competition. Markdown cancellations occur when the markdowns are later offset by increases in the price of goods that the retailer had marked down, such as after a one-day sale, for example. So let's look at Designer Clothing store here. They recently purchased 100 dress shirts from Marway Incorporated. The cost of these shirts was $1,500 or $15 per shirt. Designer Clothing established the selling price on these shirts at $30 a shirt. The shirts were selling quickly in anticipation of Father's Day, so the manager added a markup of $5 per shirt. This markup made the price too high for customers and sales slowed. The manager then reduced the price to $32, and right after Father's Day, they marked down the remaining shirts to a sale price of $23. And then the manager later increased the price of the shirts to $24. Couldn't make up his mind, I guess. In any event, the retail method here was the selling price of the shirt, $30. We added a markup of $5, backed out the reduction of $3, and then the company reduced the price by $9, down to $23, and then back up to $24, right? And so the price at the end then was $24. Okay. Infusion can calculate its ending inventory at cost under two assumptions, alpha and Bravo. Assumption alpha computes the cost ratio after markups and markup cancellations, but before markdowns and markdown cancellations. This assumption is referred to as the conventional method here. Assumption Bravo computes the cost ratio after both markups and markup cancellations and markdowns and markdown cancellations. This assumption is referred to as the cost method. Okay. This looks like a good place for us to stop this video, and when we return, we'll take a look at retail inventory methods with markups and markdowns. Until that time, bye for now.